You're listening to the Financial Source podcast on YouTube.
Hi, everyone, and welcome to the Financial Source podcast.
Glad to be here.
We're kicking off December with markets navigating a really unique kind of tension.
It is, yeah. Volatility isn't really anchored by interest rates right now, which is what we're used to.
Exactly. It's more about deeply entrenched geopolitical risk and, in some places, domestic political credibility.
And that's creating this collision where global sentiment is struggling to price in soft economic signals like those weak Chinese PMIs against the very high stakes of what's happening in Ukraine or the South China Sea.
We're seeing it in the currency moves, too. The Japanese yen is strengthening, while the British pound is just choppy, based entirely on domestic politics.
So we'll analyze why crude prices are staying supported, look at what's driving that volatility, and unpack those key U.S.-Ukraine negotiations. Let's get into it. So the main theme right now is that the old rules of volatility have sort of been put on pause. Well, the U.S. dollar index might look pretty flat on the surface. That's mostly because the Federal Reserve is in its quiet period before the next meeting, so there's no new guidance.
Right, but if you look underneath that calm, the dollar is being aided against some really big specific moves in other currencies.
Exactly. Moves driven by policy signals and, like you said, domestic political risk.
And that is absolutely the story in Europe. Let's start with the euro. It looked like it was ready to gain some ground, made a little attempt above 1.17, but it just couldn't hold it.
It couldn't, no. And the reason is really just foundational economic weakness.
The PMI data.
The Purchasing Managers' Index data, yeah.
Right.
It was very weak out of the Eurozone. And for anyone who doesn't follow it closely, the PMI is a key forward-looking indicator for manufacturing health.
So a weak reading means things are contracting.
Right. And that disappointing number, combined with the soft data we already saw from China, is just directly undermining any bullish feeling for the euro.
It was interesting, though, that even when European Central Bank President Lagarde said policy is at the right level, the market just worded. It completely ignored her.
It did. The growth worries in Europe are just much bigger right now than any confidence in high interest rates.
The fear of recession is really outweighing the policy talk.
It's palpable. And you can contrast that with what's happening across the channel with the British pound. It's trading so choppy, and it's almost completely detached from those macro drivers.
So why is the pound just focused on this internal drama? It seems totally sensitive to domestic political credibility, which you'd think would be a secondary concern.
Well, it's because the drama is severe enough to call government policy itself into question, all this friction around the prime minister's budget.
Right, the headlines about a fiscal black hole.
That gap between spending and revenue, yeah, it's keeping the pound whipsawed. The market is basically just waiting for Prime Minister Starmer to come out and really defend the government's financial plan.
And if he can't reassure the markets on fiscal stability,
then the pound suffers no matter what the Bank of England is doing.
Okay, so the euro is down on macro data. The pound is down on political optics. But the really explosive story has been in Asia.
With the yen.
The dollar is retreating sharply against the yen, which means the yen is strengthening. This is a complete reversal, isn't it?
A total reversal. And it's a textbook example of successful official signaling. We're not talking about actual intervention.
Not buying up yen on the market.
No, just verbal pushback that the market actually believes. Finance Minister Katayama came out and said recent currency swings are not based on fundamentals. That's basically code for telling speculators they're on the wrong side of the trade.
And then the Bank of Japan backed him up.
Crucially, yes. Governor Ueda signaled that a December rate hike is still very much on the table. He really emphasized that Japan's inflation targets will likely be met.
And that hawkish tilt, the idea that they might finally exit negative rates.
Yeah.
That's what the yen needed.
It's exactly the policy certainty it needed. It was an unusual level of clarity, and traders just had to react.
So a clear policy signal strengthens the yen. Pure political drama hits the pound. But the other Asia-linked currencies are lagging.
They are, and it makes perfect sense when you think about it.
The commodity currencies.
Yes.
The Aussie and the Kiwi dollar. The Antipodeans. Why are they feeling the most pain?
It goes right back to those weak Chinese economic data points we mentioned.
Because they're so reliant on Chinese demand.
Exactly. Australia and New Zealand are huge export economies. Iron ore, dairy, you name it. When the Chinese Purchasing Managers' Index misses, their economies feel it almost immediately.
And the local data out of those countries confirms that connection.
Absolutely. Corporate profit data in Australia missed expectations, and New Zealand's data showed very little new momentum. If the engine of Asian growth, China, is slowing, the Antipodeans are the first to hit the brakes.
The market just sees them as a proxy for global demand.
And right now, that looks pretty fragile.
Speaking of fragility, there was a really specific, almost small anecdote about global trade that caught my eye, about agricultural products.
Yes, it's a great example of how easily these specialized supply chains can get disrupted.
The pork imports.
Right. We saw this localized but, notable shift after China banned pork from Spain's Barcelona province because of disease concerns. Then Mexico followed and did the same.
And while it's contained for now, it just shows that these risks aren't just for big things like oil tankers.
Not at all. They can suddenly shut down niche trade flows and really impact global protein markets or cause localized food price spikes. It all adds to the uncertainty.
All right, so moving from those volatile currencies to commodities, which have been sticky, crude oil is starting the week looking, well, pretty supported.
It is, which is interesting, isn't it? Usually if you see soft global data and recession fears, you'd expect oil prices to soften too.
On-demand fears, yeah. So why are they defying gravity?
Because right now, supply discipline and geopolitical risk are just outweighing those weak demand signals. The market is basically looking past the soft Chinese PMI.
Because the supply side is so anchored.
Thanks to OPEC plus XR, they confirmed they're maintaining current production levels all the way through the first quarter of 2026.
Okay, so if you know supply isn't going to increase for over a year, that just creates a floor for the price.
A structural floor. And then you layer the elevated geopolitical tensions on top of that. With no new supply coming, the tone for crude stays bullish. It's that risk premium keeping crude elevated.
Which means higher costs for everyone.
Transportation, manufacturing, consumers. It's a key inflationary anchor.
And that structural tightness is visible in industrial metals too, right? Though the price action there is much wilder. Copper, especially.
Copper is the perfect poster child for this fight between long-term supply tightness and immediate demand worries. It hit fresh all-time highs, climbing above $11,200 per ton.
And then it just pulled back sharply.
Right after that weak Chinese PMI data came out, yeah.
So 1 minute, it's pricing in the green transition,
Yeah.
all the massive long-term demand for electrification.
And the next minute, it's pricing in a global slowdown.
And that friction is what creates these huge intraday swings.
Precisely. The reason for the structural tightness is real. The world needs huge amounts of copper. But the short-term engine of demand is China's manufacturing sector. If that stalls, traders just pull back hard.
The future demand promise doesn't save you from a current recession scare.
Not at all.
And what about the safe haven players? For people looking for refuge from all this confusion, what happened with gold and silver?
They held up initially. They were supported by soft yields and some early risk hedging. But they did give back some of those gains as the equity market found its footing later in the week.
Silver hit a new high, though, didn't it?
It did. Briefly touched a new all-time high before easing back. But what's fascinating is that even when the price settles, the fact that these metals broke resistance, even for a moment, tells you something.
That the underlying pressure is still there.
Exactly. The inflationary concerns, the risk-off pressure, it's all still there, just waiting for the next headline to spark another round of buying.
Okay, let's pivot to what we call the central anchor for volatility right now, which is geopolitics. And there's a lot of ground to cover, but let's start where the immediate high-stakes talks are happening, U.S.-Ukraine.
Right. This is where a huge amount of the current market risk premium is coming from.
There were 5 hours of talks over the weekend.
Intense talks, described as difficult but productive. The thorniest issue, and it's a huge one, is defining a new de facto border with Russia.
This isn't just a local issue. This is something that could redefine the map of Europe.
It absolutely could. It could lead to a new prolonged period of instability or, on the other hand, a massive relief rally if we get some kind of clarity.
I did notice U.S. Secretary of State Rubio called the talks very productive, but then immediately said more work needs to be done.
Which is pretty classic diplomatic code, isn't it?
It sounds a lot like we are nowhere near an agreement.
It certainly underlines how deep the disagreement is. I mean, they're negotiating the sovereignty of territory. And while that diplomacy is happening, the conflict itself is escalating.
Ukraine struck critical Russian infrastructure.
An oil refinery in Afipsky, and also 2 Russian-linked tankers that were part of that shadow fleet trying to get around sanctions. Russia immediately retaliated with massive missile strikes.
And this isn't just localized anymore. Moscow condemned the strike on the Caspian Pipeline Consortium's Black Sea terminal.
They called it an attack on critical global energy infrastructure.
And that connects directly back to what we said about crude oil prices, right?
Directly. When pipelines and major shipping terminals that handle huge amounts of energy for global markets become targets, the risk premium in oil is not theoretical, it's baked right in. Any more escalation there could easily send energy prices soaring.
And stepping back from the direct conflict, there's also this big, long-term strategic shift happening inside NATO.
This is a massive shift in strategic calculus. NATO military leadership has publicly signaled that the alliance is preparing for scenarios where Europe has to defend itself with potentially limited U.S. support.
Following reports that the U.S. is already reducing some deployments.
Right. So the prospect of European defense without the immediate full backing of the U.S. fundamentally changes everything for them.
Financially, what does that actually mean?
It means European defense budgets are set to surge, moving way beyond that traditional 2% of GDP target. The market implication here is pretty clear.
A boom for European defense contractors.
It's a guaranteed multi-year pipeline of orders. It's basically become a secular growth story that's being driven by acute necessity.
Okay, let's move quickly to the Middle East, which is still incredibly fragile. What were the key indicators of rising tension there this week?
Well, the intensifying legal and political pressures inside Israel are a big one. Prime Minister Netanyahu had to deliver a formal letter to President Herzog, which points to deep domestic instability.
And on the ground.
Israel carried out strikes inside Khan Yunis, but the biggest risk indicator came from security services.
The warning about Iran.
Warnings that Iran may lead future retaliation directly, instead of using its traditional proxy groups.
That would be the worst-case scenario for the region.
Absolutely. Bypassing proxies like Hezbollah would be a severe escalation. It would raise the immediate threat level to global oil shipping through the Strait of Hormuz.
And Iran is also engaging in some unusual diplomacy, it seems.
They're playing a kind of dual-track game. Iran's foreign minister held high-level talks with both Turkey and Saudi Arabia.
Which is not a common occurrence.
No. And that suggests a really high-stakes effort to either coordinate a response or at least manage the regional dynamics. Either way, it shows major powers are preparing for a potential conflict.
And finally, we can't ignore the pressure building in the Asia-Pacific. The headlines there feel very acute right now, especially around Taiwan.
The tension is definitely accelerating. Taiwan's President Lai announced a historic $40 billion defense package.
Aimed specifically at asymmetric capabilities.
Things like high-speed metals, unmanned systems, weapons designed to level the playing field against a much larger force. Taiwan's defense minister said flat out that China is accelerating its military pressure.
And this isn't just theoretical posturing.
Not at all. At the same time, China is conducting these highly visible combat readiness patrols around Scarborough Shoal, which directly raises tensions with the Philippines.
So you have all these flashpoints happening at once.
Yes. And that is what's providing the lift to oil and gold, regardless of what the soft macro data is saying elsewhere.
So we have this historically intense geopolitical backdrop. Given all of that fear and uncertainty, how did U.S. equities finish the week? Surprisingly resilient.
They did. They ended broadly higher, really just supported by post-holiday flows and not much in the way of domestic macro data.
The bid was strongest in cyclicals and tech.
Which suggests some optimism about a soft landing still exists, yeah. Though healthcare lagged a bit after its strong run in November.
But that buoyancy didn't last long, did it? U.S. equity futures slipped overnight.
As soon as Asia opened and reacted negatively to those weak Chinese PMIs.
So the immediate risk tone is cautious.
It's cautious, it's not a full-blown panic, but the market is highly sensitive. Any headlines suggesting an escalation in Ukraine, a clash in the Middle East, or anything in the South China Sea leads to immediate selling.
And that sensitivity really defines what we need to watch next.
As December gets underway, the market is navigating this incredibly difficult mix. Huge geopolitical negotiations, fragile global growth, and commodity markets defined by supply discipline and political risk.
It almost feels like the new job for central banks isn't managing inflation, it's managing geopolitical fallout.
The focus is absolutely shifting. So our attention goes straight to the next round of global PMIs, the U.S. ISM data to see how strong the domestic economy is, and, critically, the next set of U.S.-Ukraine negotiations.
Those talks could really redefine the landscape heading into 2026.
If a new political border gets established, the market will finally start pricing in a new long-term reality. The next 48 hours are definitely pivotal.
And here's a final thought for you to consider as you navigate these markets. If policy signals, like that verbal pushback from the Bank of Japan, can now instantly overpower months of macro trends.
And political friction, like the UK budget drama, can completely unhinge a major currency.
Does that mean fundamental economics has become secondary to political risk management?
Yeah.
You might be better off reading diplomatic cables than inflation reports right now.
That concludes our discussion on the market landscape as December begins, defined by tight supply, soft data, and acute geopolitical risk.
We really appreciate you tuning in for this essential context and encourage you to join us again next time on the Financial Source Podcast.